Thanks,
All right,
guys.
team. Thank you. And
Cheers,
Jim,
guys.
thank you for your patience. Appreciate you being here.
No problem.
You know, Jim,
Blake gets excited.
yeah, and you know what? I remember when we booked this interview, your comment was the world should look much different by the time we have our interview. Maybe we booked it back in what, November or something for this, or December. And you're definitely right. And I think that you were probably talking about what might happen in the financial markets. You didn't see a war with Ukraine, Russia and Ukraine coming, did you?
No, I can't say that I saw a war with Russia and Ukraine. You know, we clearly had the Fed and what they were going to do with interest rates in the crosshairs. And you know, so now we're battling it out to see what's going to have a bigger impact on markets. Is it going to be whatever the Fed does and whether they are able to walk the tightrope, or, you know, now we've got huge geopolitical risks rattling around. So
do you want to share your screen, Jim? Was there anything, or you just want to
talk? No, I would actually.
Okay, so it's the green button on the bottom. It says share screen. Just move your cursor over the bottom. Let me do that.
Let me go find, here we go.
There we go.
Okay.
All right. Okay, so go. Oh, you prepared a little PowerPoint.
I got a few slides. Yeah, let me see if I can get this full screen. Are you still seeing it?
Yeah, we can see it. It's fine.
Okay, so I know I'm the volatility guy, but this little list of things that people can put money in just really has grabbed my attention recently. This is looking at 3-month total returns across a set of kind of the usual suspects that people might want to put some money in. And I find it fascinating that over the last 3 months, only 4 of these things are in positive territory. 3 of them are absolutely tearing it up.
Yeah.
And everything else looks terrible. You know, if you're not in metals mining, energy, and Latin America, you're talking to your clients about how they need to be patient and disciplined.
Do you think the Latin America performance is based upon that they're commodity producers rather than importers?
Sure, absolutely. I mean, you know, and a big chunk of Latin America, when you look at what's underlying this ILF ETF, is Brazil. But you know, and Brazil is commodities, is energy, and the other countries are commodity as well. So very clearly, you know, the market has swung around and said, look, the trend is commodities. Whether it's inflation, whether it's geopolitical risk, it doesn't matter. But if you don't have a way to tilt your portfolio into this space, and obviously there are other ways to play it, you are, you know, feeling the hurt. Now, maybe, you know, you're feeling the hurt relative to, you know, domestic US. And so you can say, well, gee, you know, we're not down as much as the S&P 500, or we're not down as much as Europe, but, you know, you're still down. And
you know what? It depends. It depends where you're long from. Like I had a
I understand.
You know, the last 3 years have been historic in returns and performance. So, but you know what? People feel like that, Jim. You know, I've had a relative go, "Oh, I'm losing so much money." I said, "You're not losing money. You're giving back profits."
Exactly. No, that's absolutely true. But you know, we live in a world, particularly if you're in the advisory business, where you know
your high watermark.
Well, and what have you done for me lately, right?
Yeah. You're only as good as your last trade in our business.
Exactly. Anyway, this is the volatility guy talking about asset class returns. So let me move to the next one.
Okay.
So one of the ways I like to keep track of what's happening in VIX and the volatility is looking at the CBOE volatility term structure. What I like about this is these are, you know, constant maturity measures of volatility. And, you know, where we stand right now, 2 things, very elevated. I've put on here the sort of year-to-date average, as well as last year's average. I didn't go back to 2020 because obviously we know that that was a very volatile period. But we're coming off of 2021, where we had the kind of term structure that people expect, lower left to upper right, what we call contango. And I recognize that this is a different way of looking at it than the VIX futures, which we'll get to in a second. But to have all 5 of these data points hovering up at the 30 level is highly unusual, and says that nobody is sanguine about the prospects going out literally a year. And that's
that's
very
a
unusual
statement of confidence. Have you ever seen that before?
08,
08?
We didn't have the 1-year VIX back then,
Okay.
and 08 was generally more backward and obviously highly volatile. But certainly since 08, except for brief periods, you don't see something like this. And look, I think this is clearly a statement of investor perspective related to what's happening with interest rates and the Fed and the potential knock-on effects of whatever action they take, plus this new geopolitical risk that we're facing. So people are hedged up. They are paying up for protection. And a lot of people are looking at this and saying, wow, how do I short this? Because sooner or later, we're going to get some resolution in Ukraine. Sooner or later, we're going to get some resolution around interest rates. I need to take the other side of this trade. And that may well pay off, but it's a little bit like what Blake was talking about with crude. You want to short crude right now?
Yeah, you want to short volatility right now? Yeah.
Maybe not. Anyway.
Yeah. One day event, one day could clean your house.
Exactly. Flipping it over to, what a lot of people in my world are more accustomed to looking at, which is the VIX futures. Again, we're seeing this term structure that is slightly backward, i.e. upper left to lower right, and frankly, very flat, very elevated, reflecting a great deal of just unease, uncertainty going out, as far as we can go with the open futures contracts, and a significant change from where we started the year. We started the year, albeit somewhat elevated, but we had the more or less, expected contango shape to the curve, and we just don't have that right now.
Jim, can I ask you, do you follow bond volatility? Because I believe I've been reading the stress there is even higher than in the stock market.
I don't have a chart available right this second, but yes, there's something called the MOVE index that tracks expectations, bond volatility expectations for the bond market. And what we did see was we saw the MOVE index moving higher, even as the VIX, the equity volatility expectations, were relatively calm earlier in the year.
Yeah, nice tell maybe for us to learn about next time.
Yeah, I think some people say, "Hey, come on, it's kind of disconnected. It's not a reliable tell." And in fact, the guy who invented the MOVE index, a guy named Harley Bassman, who is now with Simplify ETFs, has suggested that he wouldn't read too much into it as a tell, because the two markets aren't necessarily. But there's the old Wall Street view that the bond market is smarter than the stock market. And there may be something to that. I think the other thing that I watch very carefully are high yield spreads, and yields in the high yield market. And while we've seen those begin to tick higher in the last couple of months, we really haven't seen the kind of breakout that we saw in prior instances where we had a really weak equity market behind that uptick in yields. The credit markets seem to be okay right now. We'll see if that continues.
Okay.
A couple other ways that I look at my little world. Again, this is a different look at the CBOE indices. I look at the ratios. So you've got these 4 or 5 different measures, but this is a way. If you look at these, the red line is the 9-day against the 30-day, and the 9-day should be below the 30-day. If we're in a calmer market, and you saw that back in January, we had a significant little eruption, and right now these 3 lines are just kind of flat and tangled. So again, to me, that's another sign that markets really just aren't sure. You guys were talking about the possibility that we could get a rip and rally in equities, and the flip side is if something goes really wrong, either at the March Fed meeting or in the Ukraine, we could be headed down to new lows again. So
Yeah,
the market
4,000,
basically,
3,800.
yeah, the market is basically saying, look, I don't know what's going to happen in here, and I'm gonna put all my risk right in the middle.
How are you, Jim, with doing nothing when you don't have conviction?
Oh, I do nothing far more often than most people are comfortable with. I'm
Okay.
very happy in markets like this to be sitting on my hands. One of my mentors drilled into me the concept of the second mouse. The first
That's
mouse, the first mouse, yeah, exactly. You don't always want to be the first mouse, right?
Yeah.
And this is a situation where, look, if you want to be the first mouse, shorting volatility, shorting crude, I don't know, whatever it is, and that might work out really, really well. And when you're the first mouse and you get it right, you can be rewarded in an outsized fashion. The flip side is, you can just have your face bashed in. And frankly, I'm not pretty enough to want my face bashed in any more than it already is.
No, that's wisdom, Jim. There is wisdom in saying, I don't know what's going to happen. A lot of people feel uncomfortable. They feel like they should always know. And I think it's wisdom to admit to yourself and to whoever you're working with or people depending on you to say, I don't know, instead of trying to entertain them with risk.
I think it's not easy to do. We fashion ourselves to have some expertise, but I totally agree with you.
How about on Twitter? No, do you ever see anyone say I was wrong?
Those tweets get deleted very quickly, don't they?
Yeah, I don't know. They get deleted. They just aren't written, is my view. So okay, so you're neutral right now. Is there anything that we should be looking for that's going to give us, kind of like more conviction, or are we just in a range where right now you're looking to either sell a rally but not here, or buy a break to new lows and we're not there, and in between, like we were just talking about, you don't do anything? Are people doing strangles or any other type of option strategies with the way the VIX is situated here?
Yeah, I think there are, and I'm not the options expert.
Yeah.
I have some people that I can tap into for that expertise. But
what do you mainly trade, Jim, when you're when you're getting signals? What do you trade?
Yeah, so on the broader, going back to that chart of the asset class returns, I have a couple of flavors of cross asset tactical strategies that I manage. One of which, no surprise, currently owns XME, XLE, and ILF, because it's a relatively short-term trend following strategy. There's
What are
another.
the three? I didn't get.
Well, they
XLE.
were the three that were at the top of the list that I showed.
Okay.
XME, XLE, and ILF. So,
I got
that's a short-term trend following strategy that basically says I'm only smart enough to go where everybody else is going. And when the market changes, when the herd changes its mind, I'll change my mind too. I have a longer term strategy that is slower moving, more tax efficient, and tends to own a lot of equities, broadly based. And in the volatility landscape, I use the exchange traded products, so VXX, SVXY, and I'm involved with a company that is in the process of introducing some new exchange traded products in the vol space that will represent an improvement in the mechanics of how they trade, how they rebalance, and we're hoping to have those products launch sometime soon. That's all I can say.
Okay. So Taroso, are they an RIA?
Yes.
What kind of okay.
Yeah, Taroso is a three-legged stool. One leg is a more or less traditional wealth management business where we work with high net worth individuals. We have several advisors who specialize in the retirement planning space, corporate retirement plans. The second leg of the stool is an investment management business where we run a wide array of separate account strategies. We also are an outsourced chief investment officer for organizations that are better at collecting money than they are at managing it. And our third leg is a business where we help people who have ideas for ETFs actually crystallize those, get them launched, get them marketed. Examples are SoFi, SoFi Stadium, where the Super Bowl was played. That organization came to us when they wanted to launch a suite of ETFs targeted to their clients. We have our own ETF in the blockchain space, BLOK, which invests primarily in what I refer to as the picks and shovels of the blockchain. So we're very, very active in the ETF space, and also, as an asset manager ourselves, both for individual clients and sort of the crossover market of money managers who don't actually manage money, and some institutional accounts.
Okay, I know I've interviewed someone from your firm prior. Anyway, I have old timers. So at the moment, so Jim, we have time for maybe another slide to talk about what you're seeing, and
so let me just
confused. Yeah.
So again, using the SIBO indices, this isn't just looking at the levels of the 9-day, 30-day, 3-month, 6-month. It's when the normal setup, if you will, is 9-day below 30-day, below 3-month, below 6-month, as one would expect. When the markets get upset, they collect together. Sometimes the 9-day popped out a big time, at the end of January. And again, we're in this place where they're all clustered together. And, that's a flat term structure. That's basically the market saying this ain't normal. And we don't know which way it's going to go. So again, I think the market's confused. And the last thing I will do is say, one of the ways that I look at the VIX itself, just the one measure, is, and there's been research out there on this. One of the things that tends to happen is in reasonably normal markets, S&P, generally trending higher, the VIX will quiet down. And, one way to frame this is that it will get into a, what I sometimes refer to as a sideways quiet channel. It starts just trading, with small daily moves, more or less sideways. And these little red dots are what John Carter calls a squeeze. And as you can see on this, these are just two examples of a phenomenon that's not unusual. There's no guarantees, right? Mm-hmm. But if you see the VIX in a multi-day squeeze the way you did in mid-December, the way you did in early January, sometimes you might see it leave that sideways quiet channel to the upside. And so, if you're watching the VIX and you want to trade something in here, you might set up a chart that looks something like this and look for those little red dots. That is not a trade recommendation.
Okay, the little red dots are what's it called?
John Carter, who you may know, Simpler Trading. It's called he calls it the Trade the Markets, TTM.
Okay.
And the squeeze means that the Bollinger Bands, it's basically using both tightening. Bollinger Bands and Keltner channels. Yeah, they're tightening. And the Bollinger Bands have gone inside the Keltner channels. That's what the squeeze is. So it means that, things have gotten quiet, they've gotten tight, they're coiled up, and there's a chance that, you'll get a move out of that situation. Compression needs to be released.
Yeah. Well, I kind of vacillate between confused and agitated on your last chart for about a month. And Jim, really a pleasure to be able to speak to you and for you to take time. I know you have half an hour before the market opens, but the best way for people to keep in touch with you or get in touch with you?
Well, the easiest way is to follow me on Twitter at VIXologist.
Okay.
My DMs are open. If people want to get in touch with me, I'm happy to interact with folks on Twitter. Cool. Email is jcarroll, CARROLL, at torosoadvisors.com.
Thank you, my trading warrior brother. Everybody, a great interview that we had with Jim Carroll at VIXologist. Thank you so much, Jim.
Thank you, Dale.
Your time. Thanks for giving, edifying the community today. All right, thank you. All right, adios, Jim.
Cheers.
Okay, everyone, that's a wrap for us. Remember, don't just count your red dots, count your blessings. And also, you could join the team in about 17 minutes for the morning edge. Good luck. And like Jim and Blake are saying, please, reduce leverage. And they say that tough markets don't last, tough traders do, but don't be, as Jim said, the first mouse. I've tried it. Those traps, when they spring, they don't feel good. Thank you, Paul. Everyone's thanking you, Jim. Have a great day, everyone. See you tomorrow. Adios.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.